Mr. Keki Mistry has started to speak.
Accounts for the year ended March 2019. So I'll spend some time running through some of the financial numbers and maybe we can take a few questions after that. Our total loan book stood at 4,61,913 crores on an AUM basis as compared to 3,99,511 crores last year at this time. The total loan book growth was on an AUM basis was 15%. But if you look at the individual component, and our focus in this year has largely been on individual loans, as we mentioned in the December meeting and we mentioned even in the September meeting, the individual loan book on an AUM basis increased by 17%. This year we have sold a significantly larger number of loans than we normally do. The total amount of loans we sold this year is 25,150 crores of rupees compared to 6,453 crores in the previous year. The reason for the larger sale of loan is because of the sale of loans to HDFC Bank. As you know, we have an arrangement with the bank where the bank sources loans for us. We do the credit, legal, technical checks. We decide whether to lend money to a particular customer or not. If we decide to lend money, we make the disbursement, and then the agreement we have with the bank is they have a right to buy back up to 70% of these loans. Now, in respect of the previous year, there was a big question mark around the applicability of GST on sale of loans, and this is something which we had talked about last year. And accordingly, till the clarification on GST came, which came only in the quarter April to June of 2018-19, because of the lack of clarity, we did not sell any loans to in the previous year, in 2017-18, other than what was sold in the first quarter of the financial year. And therefore, the backlog of loans of 2017-18 was sold during 2018-19, which is the reason why the total amount of loans sold this year is significantly higher than what it was in the previous year. So therefore, the most appropriate way to look at growth would be on an AUM basis. If we were to add back the loans we sold in the last 12 months, then the individual loan book growth would have been 24% and the overall growth in the loan book would have been 19%. As of 31st of March, we had a total of 54,601 crore rupees worth of loans which have been sold by us but which continue to be serviced by HDFC. So in addition to the loans that are outstanding in the balance sheet, we also have this 54,601 crore of loans which are being serviced by us. Our focus on the affordable housing segment continues unabated. During the course of this year, 37% of the number of borrowers who took loans from us would qualify under the EWS or the LIG segment. So it is 37% in numbers, but 18% in value. So 18% of the total loans we gave in the current year were to customers who were in the economically weaker section or in the lower income group. Our average loan size for borrowers in the economically weaker section is 10.1 lakhs, 10,10,000. An average loan amount for borrowers in the lower income group is 17,50,000 rupees, 17.5 lakhs. Our overall average of loans that we've done in the current year stood at 27 lakhs. If we were to break down the loans outstanding on a balance sheet basis, on an AUM basis, between the different categories, individual loans constitute 74% of our total loans, construction finance constitutes 12% of our total loans, lease rental discounting loans constitute 9%, and corporate loans constitute 5%. So this is a breakdown on a balance sheet basis. If, however, we were to look at this similar number on an incremental basis, that is, we look at the loans outstanding on 31st March 2019, compare it with the loans outstanding on 31st March 2018, and then see how the growth has come in which component, which category, then you will see that the individual growth, the individual loans constitute as much as 85% of the growth in the loan book during the year. So individual loans constitute 85%, construction finance constitutes 10%, lease rental discounting loans also constitute 10%, and corporate loans actually are a negative 5%. So, as we mentioned when we were declaring the results for September and December, our focus during this year has largely or significantly been on individual loans. We continue to reflect all the investments we have in our subsidiaries and in the bank at its original cost and not at fair value. The unrecognized gain, the difference between the market price of these investments and the price at which these investments are held in the balance sheet, that difference is as much as 1,87,386 crores rupees. This 1,87,386 crores does not figure anywhere in the balance sheet, but it is the underlying strength of the balance sheet because it reflects the difference between the market price of these investments and the price at which these investments are reflected in the balance sheet. The book value of our share on a per share basis, if you were to exclude the unrecognized gain on listed investments, stands at 451 rupees. And if we add the unrecognized gain on these listed investments, then the book value per share would go to 1,607 rupees a share. Capital adequacy, which does not take into account this unrecognized gain on the investments, is high. It stands at 19.2% against a regulatory requirement to hold 12% capital adequacy. Out of the 19.2% capital adequacy, Tier 1 capital stands at 17.6% against a regulatory requirement to hold 6% currently, and Tier 2 capital currently stands at 1.6%. So the breakdown of the 19.2% capital adequacy is Tier 1 17.6%, Tier 2 1.6%. Gross non-performing loans were marginally lower than what they were in December. In December, the gross non-performing loans were 1.22%, and in March, this number stands at 1.18%. If we break down that 1.18% between individuals and non-individuals, individual gross non-performing loan number stands at 70 basis points, that is 0.70%, and non-individual non-performing loan stands at 2.34%. During the year, we have provided 935 crores towards provisioning, and on 31st of March 2019, we carried a total provision in the balance sheet of as much as 5,880 crores. This compares to a regulatory requirement to have a provision of 3,220 crores. So as we have consistently kept doing over the years, we keep over-providing. We keep providing at a level which is higher than what the regulations require. We've been extremely conservative with our provisioning policy, and we continue to remain extremely conservative with our provisioning policy. Now, as you know, in the current year, we have moved to a new regime of accounting, which is the Indian Accounting Standard, INDAS as is commonly called. There are certain structural differences between the way INDAS accounts for certain items of income and expenditure and the way the old accounting standard looked at items of income and expenditure. So there is a reconciliation that has been given of the profitability of the previous year and the capital and the net worth of the previous year based on the old accounting standards versus what is applicable based on the new accounting standards. One of the differences between which the new accounting standard has imposed is with regard to income from securitization. When we sell a loan in the original scheme of things, the difference between the interest rate at which the loan was given and the interest rate at which the loan is sold, that difference used to come to the P&L account over the life of the loan. Under the new accounting regime, that income we have to first set aside a certain amount for expenses, and then the balance has to be accounted for upfront on a discounted basis. So for the quarter, the income that we would have earned on securitization was 66 crores rupees, and in the previous year's fourth quarter, that income was 68 crores. So there's no material difference in the income on securitization fourth quarter of this year versus fourth quarter of last year. Net interest income stood at, now net interest income we have calculated with that securitization and without that securitization, and you obviously will have different numbers. So if we include the securitization income, then in the fourth quarter of this year, net interest income stood at 3,227 crores of rupees compared to 2,718 crores in the previous year, giving an increase of 19%. For the 12-month period, net interest income stood at 12,263 crores compared to 10,169 crores, giving an increase of 21%. But this is including securitization income. If we exclude securitization income, then for the quarter the net interest income would not be significantly different because there is not that much of securitization that has happened this quarter. The net interest income in that case would be 3,161 crores compared to 2,650 crores in the previous year, giving a similar increase of 19%. And if you look at the whole year, the net interest income for the 12-month period stands at 11,403 crores compared to 9,635 crores in the previous year. Net interest margin stood at 3.3%, but in the fourth quarter, if you look at the quarter in isolation, net interest margin was closer to 3.5%. Spreads slightly higher than what they were in the December quarter. December spreads stood at 2.26%, and for the year ended March 2019, spreads stand at 2.30%. So gross spreads stand at 2.30%, and if we break that between individuals and non-individuals, individual spread stands at 1.91%, non-individual spread stands at 3.17%. Now the reported profit, I think it's very important for everyone to understand that the reported profit for the year is not comparable with the reported profit of last year because of the fact that in the previous year, in the third quarter, we had listed HDFC Life, and there was a huge amount of profit that we had generated at that time of that listing, which obviously has not repeated in the current year, and therefore comparison of the yearly figure, the annual figure for this year will not be correct if you were to compare that with the last year. But it is possible to look at a comparison of the profit for the quarter. So if you look at the quarterly number, the pre-tax profit for the quarter stood at 3,691 crores compared to 2,602 crores in the previous year. This is on a pre-tax basis, giving an increase of as much as 42%. If we look at the whole year, the pre-tax profit stands at 13,119 crores of rupees. Tax provision for this quarter is a lot higher than what it was in the fourth quarter of last year. The reason being that in the fourth quarter of last year we were under the MAT regime, the minimum alternate tax regime, because of the lower tax that was applicable at the time of listing HDFC Life. So on a post-tax basis, our profit for the quarter stands at 2,862 crores of rupees compared to 2,256 crores in the previous year, giving an increase of 27%. Total comprehensive income is not significantly different from the PAT. Total comprehensive income for the quarter stands at 2,823 crores compared to 2,177 crores in the previous year. And if we were to consolidate our share of profits of the different subsidiaries and HDFC Bank, our share of profits, the consolidated profit for the year stands at 15,622 crores compared to 11,980 crores in the previous year, which gives an increase of 30%. So this is a broad summary of the results. The directors have taken the results on account and have recommended a dividend of 21 rupees for the year, of which 3 rupees 50 paisa has already been paid at the middle of the year as an interim dividend, and therefore there is a final dividend of 16 rupees and 50 paisa per share of 2 rupees. So the total dividend is 21 rupees per share of 2 rupees. So happy to take any questions.
We'll take questions one to one. We'll close. Sir, we'll take questions one.
Okay. Is that okay?
Yeah.
Thank you. Thank you very much.